Morning, Steve Free in Chicago with the morning grain comments. Well, happy Friday to everybody, and hope everybody has a safe and happy weekend. As far as the markets are concerned, we've had a very interesting week this week. Early in the week, we were making new lows because of increased U.S. corn and soybean crop ratings and a mostly negative outlook for demand because of COVID. And then on Monday, we saw an unbelievable windstorm move across, especially the state of Iowa, flattening maybe 10 million corn acres and causing some infrastructure damage. The market kind of rallied on that a little bit. We had the USDA report, which was basically a slightly bearish report, especially soybeans. And then after the report, a division of the USDA, the FSA, came out with some acreage numbers implying how many acres farmers planted and enrolled in the crop insurance program. The numbers were quite a bit below what the market was expected, and we had a huge rally with huge volume, taking out some key resistance levels and running into some huge farmer selling. Personally, I think that those numbers are wrong. FSA even admitted that they've had a delay in data for the enrollment, and I assume that in the next few months these acreage numbers will come up and justify the USDA's planted acreage number. We do fear, though, that on Monday the USDA is probably going to drop corn ratings 4 to 5 percentage points and maybe soybeans 1 to 2 percentage points. So I don't really believe that we've put a bottom in the markets at this time, and I do think we will trade lower and take out the recent lows as we go into the fall. As far as wheat is concerned, we continue to see Russia and Baltic wheat FOB prices drop. They're looking for demand. So I think the USDA world production numbers are too low, and I think that their demand numbers are too high. That'll keep a lid on wheat prices and maybe even have them trade lower. Tomorrow, we will have a U.S. and China trade discussion. Insiders say that they've been talking for weeks and really haven't resolved, especially them coming in and buying what they said they would under the Phase 1 trade deal. They're not interested in U.S. corn, ethanol, or DDGs. They continue to buy sorghum. They've slowed their pace in buying pork, and they are buying new crop soybeans. And I think they'll continue to buy new crop soybeans. But given the size of the global supply, I don't think that their buying of U.S. ag goods is enough to support prices. Outside markets, trade is uneasy because of politics, COVID, bank stimuluses, Congress slowing and giving a new aid package to people that need it. And so we're still seeing a lack of significant increase in demand in fuel, which hurts the ethanol market. And we're not seeing the increase in food yet that would support higher prices. Yesterday was probably the first day that we actually saw some written materials by some experts about inflation. And they're talking about hyperinflation once the virus is behind us. For many of you that are as old as I am, you remember that before we had inflation financial tools, soybeans was traded higher if there was a scare of inflation. Again, no one is looking for inflation now or in 2021, but once we have a virus, we could see some inflation. First, though, we are concerned with fourth quarter demand for raw materials because of COVID. As always, these are my thoughts and not those of ADM or ADM Investor Services. Have a safe and profitable trading day. And remember, always treat people like you yourself would like to be treated.